Welcome to the Zions Bank Economic Update. My name is Joseph Mayans, and joining me is Robert Spinlove to discuss the current economic conditions. Robert, the last time we met, we spoke about the reintroduction of volatility into the equities markets, largely based on the fact of fears of rapidly rising inflation. Now that we have the new employment release out, we have some new CPI data out, what are we seeing? What's the market reaction?
Well, it's been a really interesting couple months. The January jobs report, which is released in February, had this a big surprise. Now, what was so interesting was it was a great report, and as a result, the markets tanked. And we were all a little surprised why that would happen. But the critical reason was we were expecting wage growth at 2.6%. Average has been about 2.5% for the past several years, and it came in at 2.9%. Now, that wage growth coming in much higher than we anticipated increases the probability that the Fed will raise interest rates, because it also increases the probability that inflation will be higher than we have been anticipating. So that was the reason why we saw that dramatic change in markets, and we saw markets drop by about 1,000 points. Now, fast forward to the February jobs report released in March, just a couple weeks ago. We saw a mixed bag. Well, on one side, we were expecting about 200,000 jobs to be created. We saw the number come in at 313,000 jobs, so a good number there. The unemployment rate stayed at 4.1%, same as last month, so that was good. One of the major strong points was our labor force participation rate went up by 0.3%. So what that means is we're pulling more people off the sidelines and back into the labor force, and that's a good thing to see for the economy. Now, on the wage front, that's what the markets were really watching closely. And again, we were at 2.9%, and that number dropped down to 2.6%. So we saw a slowing of wage growth. Now, while that's not great for workers, it means that there's a lower probability that the Fed will raise interest rates more aggressively. And then you follow that up with, we got a new reading from the Consumer Price Index, which was just above 2%, which is very close to the Fed's goal. So that was a good indicator too. So now the prospect of higher inflation and higher interest rates has dropped down.
So by and large, it seems like the most recent employment report kind of offered the best of both worlds for equity markets. You had high job growth, now a lower chance of inflation, but recently we haven't seen kind of the calm in equity markets that we saw in the latter half of 2017. What's kind of going on there? What are maybe markets reacting to?
Well, the underlying dynamic that we're seeing right now is markets are returning back to normal, and normal means volatility. And so for the last 18 months, we saw very strange market conditions where equities just kept growing and growing and growing. They kept going up. We saw over 70 days of all-time highs in 2017. That's not normal. And so over the last month or so, we've seen volatility return. We've seen markets returning to reacting to different conditions. That's not bad. It's good for markets to have that volatility back in, at least to a degree. So what we saw is the markets reacted positively to a strong jobs report and went up because of that. Now, on the other side, markets are responding negatively to signs that we could see protectionism coming out of the administration.
And so what are we seeing? What kind of policies are we seeing that's coming out of D.C.?
Well, specifically, President Trump kind of surprised everyone by announcing that the United States would be imposing broad-based, worldwide tariffs on steel and aluminum up to possibly 20, 25, or 30%. And so that has increased the fear in markets that there would be retributions.
And so why would the president sign these tariffs? I know he's often aligned himself and tied his policies to the success in the stock market. Why introduce this type of uncertainty?
Well, if you think about it, it's actually very consistent with the way the president has been for literally decades. Donald Trump has consistently had a position of America first, of anti-globalism, of more protectionism about American interests. And one of those specific areas is trade policy. And so the president and the administration is very specifically focused on helping out steel workers and helping out steel mills. And it's true, steel has suffered dramatically over the past several decades. And so this is meant to try to change that.
So when looking at this, the president's proposal for tariffs, what industries stand to benefit and who are those that may be harmed?
So like I said, the steel industry will definitely benefit. Those workers, those companies will benefit from a higher demand for those products. So also those communities that are supported by steel workers, supported by those steel industries will benefit. So there will be some people that will benefit quite a bit. However, on the other side, if the policy remains as it's been stated today, there could be a number of drawbacks or losers throughout our national economy. Number one would be the direct impact. If we impose tariffs on foreign steel, that will cause not only foreign steel prices to go up, but also domestic steel prices to go up. That could directly impact auto producers or aerospace producers. In fact, a number of industries across the U.S. that are in manufacturing could be negatively impacted. What will they do? They'll have to raise their prices as well. So it could cause inflation to go up across the country, which would again force the Fed to get more aggressive in raising interest rates. Then there's the secondary impact, which is if we follow through with broad-based tariffs to countries around the world, they may retaliate in a trade war. So we could see China increasing import prices on American goods, Europe increasing prices on American goods. Countries around the world could do that, and it could start kind of a vicious cycle of increased prices as we have more trade wars. So that's the struggle that we run into. The president needs to be very careful about how he does this.
And so, do you see this being as a net benefit to the economy, or do you think the markets have a right to be a little bit leery of this?
It all depends on how the president implements this. Now, President Trump is notorious for being a negotiator, and he often comes at a very strong position and then negotiates away from it for something that is much more palatable. The hope is that the president will do something similar with this, where his initial announcement was very bold and covered a large area. Now, if he can get to a position that's much more strategic, much more surgical, that doesn't have as large of an impact, it may have a net benefit for America. But we're going to be watching this very closely to see if that can be achieved and we can have those net positive benefits.
Yeah, I think it's going to be very interesting to see how the other countries respond and how it may affect our trade agreements going forward.
Absolutely.
So thank you, Robert. Thank you for joining us for this economic update. For more information and analysis, please visit zionsbank.com/economy.